right, thank you so much, Connell. As part of our week-long series on China Beyond the Wall, we're examining the fuel-consuming dragon and its impacts on the global economy and the U.S. consumer. This after crude oil futures closed at a record of $117.48 a barrel yesterday. Now, obviously not good news for the average consumer who is pumping gas at a record-breaking, get this, $3.51 a gallon. All this may be in part due to China's booming car sales and overall unquenchable thirst for oil. Joining us to talk about just how much the American consumer is affected by China's growing oil demand are Mitch Reiner. He's an advisor with Capital Investments, and Jeremy Haft, who is the author of All the Tea in China. It is this beautiful book right here. All right, good morning, gentlemen. Thanks so much for joining me this morning. I appreciate it.
Good morning.
Good morning.
Mitch, I know you're in Atlanta. Let's get started with you. Let's talk about these breaking record numbers that we saw yesterday. Clearly, China has made a swift move from mass transit. Now, many people talking about an explosive growth in private automobiles. How key is China and their surging demand and the kind of prices that we're seeing right now in terms of oil and gasoline prices?
They're certainly a key driver. The fact that the growing wealth in that country due to a booming economy and the infrastructure improvements and just the money that's coming into that country has just been a driving force. I mean, from an individual level, citizens are gaining wealth due to this booming economy and making a lot of different demand changes from, in terms of food, switching from rice to other grains is driving up the prices of those commodities. And in terms of oil, people are making the shift from bikes and mass transportation to their own individual cars. And as long as the state continues to keep prices low for that gas, they're gonna, that's gonna continue to encourage growth in that area.
Yeah, we'll talk about those subsidies in a moment. I want to turn to you, Jeremy, because, Mitch was talking about some of the statistics I saw. By 2010, China is expected to have 90 times more cars than in 1990, and we know that there's some subsidies in place to keep those prices low. How are these rising energy costs affecting the labor market there? Because we outsource a lot of work, as do many other countries in China. Talk to me about that relationship. What's happening?
Well, it has a huge impact on the cost model for factories. Chinese factories tend to run on razor-thin margins. So imagine you're trying to bake a cake and you can barely afford the ingredients for the cake. You can barely afford to pay the bakers. Now your raw material costs are going up. Your labor costs are going up. Labor costs are up 50% over recent runs. So you have a situation where you can no longer afford to bake your cake. And many Chinese factories are going to A, go out of business, or B, start to push costs up the chain. So up until now, the factories and the wholesalers have been absorbing these rising costs. And pretty soon, we're going to see those costs trickling down to the American consumer.
It's interesting, Mitch. I was talking to a good friend of mine. I wrote a blog on this a couple of weeks ago, who outsources their labor and their development of everything from, home goods, and said that the factories are having such a problem, they can't even keep the electricity on because they are so poorly in a deficit. Talk to me about the subsidies right now that the Chinese government is, in essence, offering the Chinese oil companies to make sure that they keep inflation tame, and whether or not you think it can work in the long haul.
Yeah, well, I mean, it's a capitalist versus a state-controlled policy issue, where basically, China's keeping the prices of the output, the gasoline or whatever, low to contain that inflation. However, the refiners, Sinopec being one of them, the costs of their inputs are going up, but yet they can't pass that on to the consumer, and then, their margins are being squeezed. So, it's an issue in the long run. I don't expect China to stop giving those subsidies to these corporations as long as they continue controlling the price of the output and not allowing actual markets to dictate that price due to supply and demand.
All right, Jeremy, let me turn to you. Two factors that people are talking about. One, just the pure factor of the risk we face with China, particularly as we're getting toward the Beijing Olympics. There's been a lot of talk about Sudan relationships that are clearly scaring the rest of the global community, because there's a perception, whether we like it or not, that because China's demand is going to grow so aggressively in terms of oil, that they will make deals with terrorist-supporting nations, and that may change the quality, the national security of our situation, in addition to what we're paying at the pump.
Well, I think that's true. I think that Chinese foreign policy and the way they project power is via their pocketbook. So we do see China cutting deals all over the world, not just in Africa, but in Eastern Europe and in Central Asia, trying to lock down raw materials for their increasing demand. Now, this may cause headaches for our policy planners, but it's actually very good news for American business because it signals China's what you called unquenchable demand. And it's not just for oil. These product recalls show that China can barely make a door doll, much less a nuclear power plant. So all the modern goods and services that China needs to grow its economy, it must import, and it's increasingly importing from the United States. So as the dollar declines, we have a huge tailwind pushing our exports over to China right now.
Oh, I like that. I like ending on a good note for the U.S. economy. That's great. All right, Jeremy Haft, thank you very much. And Mitch Reiner, and once again, I do want to mention, Jeremy, this is All the Tea in China, and I look forward to reading this a little bit more. Thank you so much. I appreciate it, guys.